I'm going to be bold and start off with my first property prediction for 2023. Here it goes. I believe our property markets are going to reset this year. And what do I mean by resetting? Well, at some time this year, our housing markets are going to reach a trough, which will herald the beginning of the next property cycle. And at that time, buyers and sellers are going to return as they realise there's not going to be any more interest rate rises and that inflation's under control. Now, don't get me wrong, I'm not suggesting there's a property boom ahead, but I am suggesting there's a window of opportunity for those who understand the forces behind the big property market reset of 2023, and that's what Dr. Andrew Wilson and I were going to discuss in today's show. Now, we're going to be talking about how the property markets didn't turn out as most commentators forecast, either on the upside, like they were thinking at the beginning of the year, or on the downside, like many property pessimists predicted. So rather than making forecasts today, you're going to be hearing some expectations and some trends and some forces that we believe will be acting on our property markets. But at the end, Andrew will be telling you where he thinks the property markets will finish off at the end of the year. And given his track record, I think it's going to be worth listening to. Now, regular listeners will know I have a weekly Property Insiders video chat with Dr. Wilson on YouTube, and this is the audio of the last show for 2022. So, welcome to today's show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment, and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
It's hard to believe that the debate about whether unvaccinated Novak Djokovic should be allowed to play in the Australian Open was only this year. What a year it's been. What a remarkable year it's been, and especially for those in our property markets. This time last year we were talking about experiencing record low interest rates. And remember, the Reserve Bank told us they wouldn't raise rates, well, at least until 2024. No one had a clue that there'd be a war in Russia and Ukraine that would create international tensions and fuel international inflation. In fact, nobody had the idea that inflation in Australia would finish 2022 in the region of 8%. But here we are, and considering all the challenges thrown at our property markets, including floods, a federal election, and the media intent on telling us the markets were going to collapse, our housing markets remained remarkably resilient. Now, it's customary at this time of the year for Dr. Andrew Wilson and I to reflect on what's transpired and then use our perspective to share with you a number of trends that we see will shape our property markets moving forward. So I'm looking forward to today's Property Insider chat with Dr. Andrew Wilson, Australia's leading independent property economist. Hi, Andrew.
G'day, Michael, and we've come to the end of the year, another year, and the word topsy-turvy comes to mind to describe 2022 in more ways than one. As you suggested, if it's not just economic policy that was on a roller coaster ride, it was also our housing markets, which usually is the same cause and effect environment. But I think we can look forward, fingers crossed perhaps, Michael, to a steadier year in 2023.
I think so. Look, our property markets really didn't unfold like many people expected, either on the upside. Many started 2022 very optimistic coming out of a boom, or on the downside, as many property pessimists in the media predicted. None of those occurred either. I guess it's been said that if you look at last year's forecasts and see how wrong they were, you probably wouldn't put much store in this year's forecasts. And currently there's no shortage of people telling us what they think is going to happen in 2023. First of all, I think it's important to understand the inherent limitations of forecasting, considering the huge impact that human behaviour seems to have in our housing market. And then there's the impact of all those external factors, natural disasters, which we've had our share of, political events, technological advances, and the impact of all these things on the property and economic markets. But let's have a talk about a couple of trends I believe will impact our market. And I agree with you. To start with, Andrew, you said next year will be less topsy-turvy. I think it's going to be a reset year. I think we're going to reach a trough, and it'll be the beginning of the next cycle as buyers return into our markets.
Well, we'd sort of headed to that position, Michael, in 2019. We'd moved through a lot of boom and bust environments, and I use those two words advisedly. And we looked to be getting to the point where we did have inflation under control, where we were entering an environment of moderating price growth, so that the peak and trough environment was flattening. And I think that was the outlook. And of course, as you suggested, human nature, evolution, whatever you want to call it, from left field came COVID and completely changed the whole box and dice. And of course, we're now playing with a new economy and a new outlook as a result of COVID. And we've basically moved into the reverse of where we were prior to COVID, with high inflation and booming economic activity, feeding each other. It's remarkable how things can change and how the outlook can be completely different. But I just want to say one thing, Michael, just adding to your comments regarding the forecasting, and I'm not going to give any great detail, but it must be a little bit sobering, given all those forecasts that we have had this year, that 2022 will actually end up being a better year for the housing market than 2018, which was the previous downturn period we had, which was an adjustment period following a strong boom in 2017. But we're actually going to have better results in terms of prices, Michael, across the board this year than we had in 2018. Not only have we not had a crash, we've had a better performance in terms of comparing ourselves with the previous downside.
You're right, Andrew. The Australian Bureau of Statistics, who I guess Australia's official statistician, recently released figures showing that the median price of established homes in 6 out of our 8 capital cities ended the year higher than they started. And the median price of houses in many of Australia's regional cities is much higher than it was at the beginning of the year. So those forecasts of the overall market slumping, they were really wrong, weren't they?
They were, and even Melbourne and Sydney, which are the markets that suffered the most this year, were the markets that prospered the most over the previous 2 years. So it was an adjustment process. And of course, Melbourne was hindered by very severe lockdowns. I still think there's some pent-up demand left in the Melbourne housing market that'll push it even higher next year. Yeah, look, it was just cheap headlines, and it's becoming almost ludicrous, the trawling out of these predictions of house price crashes and how wrong they are. And again, remarkably, it's the banks that seem to be leading the charge in terms of getting it wrong. But, next year's another year. This year has proven to be, as you said, a resilient year. And I think we've got all the positives to be moving forward next year. But again, we just don't know what might come out of left field. And that's the one thing we can never predict.
That's right. Having said that, though, it's likely that inflation will peak in the last quarter of 2022, but we probably won't realise this until all the stats come through in the first or second quarter of 2023. I guess we're going to be living with a level of high inflation for a number of years. It's not going to drop to within that target range of 2 or 3% for a couple of years, will it?
No, I think there's a couple of forces at play here, Michael. Firstly, we have had a reduction in inflation recently. Certainly the US and the UK are now, their headline inflation is lower. But when we look a little deeper into why it's lower, it's certainly been driven by a significant fall in the price of oil. And it is the lower petrol prices that are certainly improving headline inflation. But when we look at underlying inflation, Michael, which of course takes out the volatile elements such as food and fuel, we can see there's really not much change in underlying inflation. And it's the underlying inflation rate that central banks use as their guide. And that's where they're looking for that 2 to 3% range to get into. I think that's going to be almost an impossible target. It's looking like the reverse of trying to get to the 2 to 3% range 4 or 5 years ago, which was proving to be impossible. I think the only way we'll get to that 2 to 3% target, Michael, is to create significantly higher levels of unemployment. I'm going to ignore the recession benchmark that we tend to be using when it comes to controlling inflation. I mean, we could have a technical recession and still have low unemployment. We unfortunately, to get to that target range, I believe would need to have around about, I think, at least double the unemployment rate that we have now. And that would cause, obviously, significant stress. I'm not sure that governments have the political will now to do that, Michael. I think that Already seeing signs of that in Australia's government with their interference or their policy changes to wage setting. I think that they're looking to the electorate in terms of the short-term positives rather than try to fix those long-term problems with high underlying inflation.
Well, as we look at trends that are going to affect our property markets, yes, inflation is going to come under control, but will remain high. And I think interest rates are going to peak. Now, a lot of people have spent much of this year trying to predict what the Reserve Bank's going to do with interest rates. I don't think they know, because each month they meet and they're not sure, should it go up by 0.5%, by 0.25%, not go up at all. But I think there's going to probably be one or two more increases. They're trying to find that neutral level, Andrew. And when they do, and when people realise that interest rates aren't going to go up, when there's a couple of months of no interest rate rises, when they realise inflation's under control, the pent-up demand that you're talking about is going to reset the markets. I think 2023 is going to be a year of reset, the beginning of the next cycle. Not a boom, but just the market's going to move on.
Well, I think affordability will be the issue, Michael. Yes. Affordability will match incomes and the labour market and all those factors which generate the capacity to purchase a property. I think that we've still got a few interest rate increases left in the gun. I'm not sure that force will be enough to actually quell demand. We've seen that this year, that other than some sort of changes to confidence and sentiment early days when interest rates increased, I think by and large the market has shrugged it off and moved forward. And that's why we've sort of got this new reality that people are looking to offset the impact on affordability from higher interest rates with higher wages. And when you've got a job and there's lots of competition for your labour and you have the capacity to push your wages up because of that competition, you look to offset your increased costs. You improve your household balance sheet. I think that even with higher rates, this is the point, that we'll be able, and perhaps won't have the constraints that we've had previously in terms of the capacity to push our wages up. And this is obviously going to continue to fuel inflation. So there'll be some big decisions next year from the Reserve Bank, Michael, and from governments. And I'm not sure governments have the political will to do the hard yards that we did back in the early 1990s and in the 1980s as well, to be able to slam the brakes on and create the sort of stress that does impact the economy with. And I think that we'll be living with higher inflation and higher interest rates for some time, but I'm not sure that's going to impact the real issues with the housing market. And that's that we just don't have enough houses for people anymore.
The shortage is a big issue, which I'd like to discuss with you in a moment. But we keep talking about higher rates, but it's higher rates compared to those wartime stimulatory rates that we needed to get us through COVID. Andrew, isn't this more the normal sort of rates that the Reserve Bank's always wanted to sort of get the rates to? Which means if we have challenges down the track, whether it's another pandemic or recessions, whatever, they'll have the ability to lower rates. They can't stay at wartime rates forever, can they?
Well, it's all a relationship matrix, Michael, between the interest rate and the rate of inflation. And that reflects the labour market activity of employment and unemployment and how that relates to income. I mean, we could live with a higher interest rate if we have a higher income. If we have a lower interest rate, we typically have a lower income. So it's how those things move together that's important, not so much the absolute measure. And as you said, in a relative sense, I mean, 3 or 4 years ago, we had a 1% or very low interest rate, but we had very, very low incomes growth. And that was the problem in the economy. Now we have the reverse. We have a higher interest rate, but we've got higher wages growth as an offset to that. So it's a matter of finding at least a position where the balance is there between people having a job and having real incomes growth. And that's what the Reserve Bank has to strive for. But unfortunately, there's a lot of co-conditions to that are difficult to manage, not the least what's happening overseas.
Well, that's right. And that's an unknown, isn't it? Who would have thought in February when the war in Ukraine started that we'd still be talking about it now? Who would have thought that we'd be talking about another strain of coronavirus? Andrew, apart from house prices, there's also been a rental crisis, which looks like it's going to worsen because of of lack of stock and immigration rising, there's recently been some immigration figures that have surprised on the upside.
The fundamental issues will move beyond affordability in relation to interest rates and incomes. It's just that there's a significant shortage of property in this country, whether you're a tenant or an owner-occupier. It will mean you're having to pay higher prices and certainly higher rents going forward. Our latest data, Michael, even end of the year data, which is affected by seasonal factors, of course, in the rental market, has, as an example, Sydney's median rent for a house now pushing towards $700 a week, which is obviously a record, but it's after a period of flat rental increases for houses in Sydney. It's now taken off over the last 2 months. And this is just another sign, perhaps, of the impact of migration coming into the marketplace on rents. This isn't just a Sydney problem, it's a problem everywhere. And the only way, other than a really deep recession where people just hunker down and start to live with other groups, the only solution is more houses. And we certainly don't have any prospect of improving our supply side in terms of offsetting the shortage of housing that we have in this country. And that's going to be with us for the foreseeable future. And it's the same problem in many cities in the US as well, Michael. I don't think there's any solutions to this other than perhaps to avoid the rental market if you can.
Well, that's going to be hard for first home buyers because they're going to be affected by higher cost of living and higher rents. And that's why I think our markets are going to be more fragmented because, as you correctly say, affordability is going to be an issue for many, but not for others. There's still going to be people with high disposable incomes, with multiple streams of income. And there's also going to be a good opportunity, I see, for upgraders as the upper end of the markets experience larger price declines. And there's a lot of people who have bought their home 10, 20, 30 years ago and got quite some equity. So there are still opportunities for upgraders, and there'll also be good opportunities for investors in 2023.
I think the positives for home ownership are increasing as a result of the change in our big picture. I think that, home ownership is going to be even more of a necessity than it has been because of the squeeze on the number of properties that are available. And I think that means that people will strive, whether it be for investment property or owner-occupier, to maintain their position in the marketplace. And there's even more incentive for first home buyers to get into the market. And I think that'll be reinforced even more next year. And it's, again, it'll be the old mantra of bricks and mortar, safe as houses, that'll come to the fore. But I think that's becoming even more of a positive with the change in our circumstances, with higher inflation, higher interest rates, still a strong economy, but a very weak supply line of new housing coming through. And of course, at the other end of all that is another surge in migration. After our border turned off the tap, we're now back into full mass migration mode. And, they've got to live somewhere, Michael.
On balance, the fundamentals for Australia's property markets are stronger today than they were, I guess, 3 years ago before that big property boom. But the media keeps focusing on the negative headlines about the inflation and interest rates. And if you think about it, this time 3 years ago, we had a national unemployment rate of around 5.3%. Today, it's 3.4%. We've got officially the lowest unemployment rate in 70 years. But Andrew, apart from all those jobs that currently exist, I just had a look, and the Australian Bureau of Statistics suggests there are 470,000 jobs looking to be filled that are advertised at the moment, no people to fill them. So Australians should probably feel more secure than they ever have in their jobs. And now, in the first time in a decade, there's significant pressure underpinning wages growth. So if we also look at other good, strong fundamentals, Australians have got more equity in their home than they've ever had. They've squirreled away billions of dollars into offset accounts and prepaid their mortgages. In fact, Australians are wealthier than they were 3 years ago before COVID. So despite all this, though, consumer confidence is at historic lows. And I guess that's one of the things that's been dampening our property markets.
The consumer confidence measures, Michael, tend to be putting that cart before the horse to a large degree or the horse before the cart, however that works. Because I think people just say what they think they should say in those surveys, and they don't necessarily reflect what's happening in the real economy. And I'm reasonably dismissive of consumer confidence measures because you look at the real measures of confidence and that's what people are spending. Even though we had a slight downtick in retail sales over October, they're still massively over $30 billion a month and well ahead of where they were pre-COVID. And the people are still spending willy-nilly. And of course, our housing market's picked up despite all the negativity through the spring selling season. It doesn't make sense, those consumer confidence measures, when if people weren't confident, why would they be out there spending like they've never spent before and also re-engaging the housing market in an environment where affordability is falling? And there's plenty of nonsensical headlines still about crashing house prices.
Well, if we look at some more predictions, forecast for 2023, I think in due course over the year, the media is going to change it. Well, I hope it does. And it's probably going to stop scaring us about inflation and interest rates, because how often can you run that story when things are under control? But maybe they're going to look for a new bogeyman. Is it going to be a recession overseas they're going to keep scaring us about?
Well, I think that certainly the measures of economic activity, which give us that word recession, which is GDP, will perhaps translate into 2 consecutive quarters. They're sort of thereabouts now in the UK and the US, and it's a great headline. But unless it's followed by steeply rising unemployment, it really doesn't affect anybody on the ground unless they're losing their job. If we still got low unemployment and wages are rising, well, recession's just a word. Now, yes. The last recession we had, the last real recession we had, because the one we had in 2020 wasn't a real recession, it was just an adjustment through COVID. But the last real recession we had in the early 90s, I mean, we had double-figure unemployment then as well. And that was a real recession because not only did we have 2 consecutive quarters of negative GDP, we also had skyrocketing unemployment, and I'm not sure we're anywhere near that circumstance going forward, even if we did get 2 quarters of negative growth. And I'm not sure we'll get that in Australia anyway next year. But as you said, Michael, I'm sure if we get those recessions in the US and the UK, and it will have an impact on Australia's economy, particularly our resource sector, our export sector, there'll be plenty of negativity, and that can have a real impact on investment decisions going forward. But I think the secret really is that why would you be reading the media anyway? Don't you want to know what's really happening?
Yes, I agree. As we said at the beginning, don't pay as much attention to forecasts and have a look at history. But I also think when we have a chat this time next year, it's going to be a year where home buyers and investors are going to look back at the year, and some will regret that they missed out upgrading their homes or making investment decisions because the market is likely to have bottomed. And again, it's not going to boom and we're going to have fragmented markets, but we'll move to the next stage of the cycle.
Yeah, I think we're a quarter away from the Melbourne market bottoming, Michael. Maybe a little bit longer from Sydney, but certainly in that same time frame. And as you said, we'll have reasonably incremental growth going forward because we don't have the capacity to push up prices with lower interest rates or skyrocketing incomes. But nonetheless, there will be a squeeze given the shortage of property. I don't think it's too much of a stretch to say that home prices will be higher at the end of 2023 than where they started. And I think in all capital cities, all major capitals at least, will have a year of higher prices in 2023. And I don't think that's too much of a heroic or optimistic forecast.
I don't think so either. Having said that, this is the way the cycle normally works. After the downturn, we don't move straight into a boom. We go to a stabilization phase. Buyers come into the market. Sellers who've been holding off, the discretionary sellers, start to get in the market because most sellers are then buyers again. And there's a period of equilibrium before certain segments of the market start to pick up. The boom is really the last stage of the cycle. It was just a very unusual cycle driven by pent-up demand, very low interest rates, government incentives a couple of years ago, Andrew.
Yeah, and a lot of that, it's the pent-up demand that is the real secret to the pent-up demand cycle. That's the secret to the sort of the boom and bust. We had more pent-up demand because of COVID lockdowns, Michael, because people actually physically couldn't go out and engage in the property market. So when the lockdowns, because of lockdowns, but when lockdowns finished, they were out and running. So you had all that built up, dammed up demand ready to be released. When it was released, of course, it meant strong prices growth. And we've had a similar episode this year, obviously not as significant in terms of the build-up of pent-up demand through the higher interest rate, negative headline environment that affected the market in winter, Michael. But I think that gradually buyers are returning to the marketplace. And as you said, buyers are sellers and sellers are buyers. and that will gather some momentum. And once we do have clear air, which is, of course, a similar circumstance to 2019, when the market was spooked by negative headlines in 2018, once we have that clear air, once it becomes more apparent that those forecasts were just ridiculous clickbait again, then people start to think about, oh, gee, I better get in here. And then we get the reverse, which is the fear of missing out, and that creates the next cycle going forward. We're going to get the end of fear of being involved, which was what generated the market this year with higher rates. And then we'll start getting the other end, which is fear of missing out, perhaps sometime next year, Michael, particularly in this chronically undersupplied market, and particularly when we've got 195,000 migrants heading for our shores this financial year.
I think it's probably worthwhile remembering how quickly the market can change. Just think about how quickly the market changed once in 2020 we realised that COVID wasn't going to be as bad as we thought. Think about how quickly the markets changed in 2019 after the election result. Yes. And so therefore, once people realise that it's not going to be as bad as the media tells us, it's possible that consumer sentiment and the market will change again, as you say. So it's going to be another interesting year, and I look forward to catching up with you in 2023 on a regular basis for these Property Insider chats, Andrew.
Yes, look forward to it, Michael, and look forward to what the year has in store and whether there are any more surprises coming along.
In a moment, I'm going to share my mindset message with you as I discuss the importance of your wealth thermostat, a very important lesson that I learned many years ago that changed my wealth. But before I do, I just want to follow on my chat with Dr. Andrew Wilson, and I want to confirm our thoughts that we're over the worst of the interest rate rises, as the Reserve Bank has now brought up their rates to something with a 3 in front of it. At the moment, it's 3.1. And that's really where they've always wanted it to be. Not at the historically low, the wartime low interest rate levels that they had to give us during COVID to stimulate the economy to stop us going into recession then. And we also believe that inflation is near its peak. In fact, it probably already has peaked. And it seems now like more strategic investors and home buyers, they've decided to get in that market ahead of the crowd and ahead of what we described in today's show, the reset of the property market. Now, over the years, particularly in the last year, emotion's been clouding a lot of people's investment decisions, and I can understand why. Look, we experienced a wild time in our economy and our property markets too. There was a continual conveyor belt of negative messages in the media, and many buyers experienced challenges with decreased affordability and the property values falling a bit. So it's no surprise that in 2022 a lot of buyers had phobia, fear of buying early, as opposed to FOMO, which they experienced a year or two earlier. And there was this lack of consumer confidence. There was lack of enthusiasm getting in the market. And now the world's moved on, and I see 2023 as a great opportunity for those with a long-term focus to get set in the market before the rest of the world realises that, hey, this is as bad as it gets. Now, I'm not suggesting there's a property boom ahead, so correct property selection is going to be very careful, and property investment is part of a long-term process. The property you eventually buy, you've heard me say this before, should be the physical manifestation of a whole lot of decisions that you make in the right order. And if you'd like help with that, whether you're a home buyer or an investor, whether you're a beginning investor or an experienced investor, why not have a chat with my team at Metropole? Go to metropole.com.au and find out how we help buyers safely get financial freedom, safely grow their wealth so they can pass it on to future generations. Now, if you enjoy my chats with Andrew Wilson, you can always subscribe to our weekly YouTube channel. Just look for Michael Yardney on YouTube. But more importantly, you can actually spend 5 days with Andrew and myself and the best faculty of property experts I've been able to put together at Wealth Retreat. Wealthretreat.com.au will give you all the details. Again, I'll leave a link in the show notes. And I'd love to get to know you at somewhere where we work closely together to build the next 5 years of your life. Wealthretreat.com.au. And now, let's have a chat in my mindset message.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In my mindset message today, I'd like to ask you a question. What is your wealth thermostat set for? You see, I'm going to share some thoughts about the inner game of wealth. Have you ever heard of somebody saying that lack of money was their problem? You know, they may say something like, I can't buy a new car because I don't have enough money, or I can't buy a house because I haven't got enough money. But in my mind, lack of money is never really the problem. The lack of money is merely a reflection of what's going on underneath. So if lack of money is the effect, what's the cause? Now, I believe that we live in a world of cause and effect. Money is an effect. Wealth is an effect. Health is an effect. Being overweight is an effect. To solve any of these issues, you've got to start by looking at what the cause is. Here's an example so you can understand what I'm getting at. Say you've written a letter on your computer and you print it out and you look at the hard copy that's printed out and you find a typo. So you take your wipe out or one of those magic erasers and you erase it on the paper and you hit print again. Same thing. The paper comes out with a typo. How could this be? You just erased it, didn't you? So you do it again and again, but you keep getting the same result. What's happened here is you can't change the printout in the physical world. You've got to go back. You've got to change the program in order to get a different result. Does that make sense? And what's all this got to do with money and success? Well, the thing is, I believe you've got inside you what I call, and I've actually registered this trademark many, many years ago, your wealth operating system, which is a specific program about how you feel about success and money. And this program is embedded in your subconscious mind. And like the computer example I shared with you a short while ago, unless you go and change your program, unless you upgrade your operating system, you're never going to get a different end result. Your wealth operating system is what connects your inner self, your thoughts and your feelings, with the outer world, your actions and your results. Now, you've probably heard me say this before in previous mindset messages. Your thoughts lead to your feelings lead to your actions, and your actions lead to your results. So my question to you as I started off is, what is your wealth operating system set for, and where did it come from? Well, the answer is quite simple, really. Your internal programming was primarily established on the information you received in the past, especially as a young child. Things that would have influenced you then would have been your parents, your siblings, your teachers, religious leaders, the media, your culture. The challenge that I find most people have when discovering what their level of internal wealth thermostat is set for is that because it's in their subconscious mind, they can't identify the areas that they need to work on consciously. As I said, if you're like most Australians, the way you feel and think about money was established by things you heard, things you saw, things you experienced as a child from your mentors, who are basically your parents and grandparents. So this message isn't just for you, but what I'm trying to get across to you is going to help your children and grandchildren. See, if you're like most people, you didn't have wealthy parents, did you? So here's the crazy thought. Your wealth operating system and the way you feel and think about money is the same as that of your parents and grandparents, only with the mod cons of the current times. Now, it reminds me of a crazy story I heard many, many years ago from Jay Abrams, who was one of my early mentors in marketing. But he made a message then that's, I think, relevant today. And it went something like this. He said, a woman prepares a ham for dinner by cutting off both ends of the ham and putting it on a plate in the oven. And her bewildered husband asked her, hey, why do you cut off both ends of the ham before you put it in the oven? And she said, oh, I don't know, that's how my mum cooked it. Well, it just so happened her mum was coming for dinner that night. So they asked her, hey, why did you cut off the ends of the ham when you cooked the ham when I was a young kid, Mum? And she replied, well, that's how my mum cooked it. So intrigued, they decided to call Grandma on the phone and ask her why she cut the ham ends off before putting it in the oven. Her answer was, well, that's what I had to do to fit it into the small-sized pan and the small oven I had in those days. What does this mean for you? Right now, it's very likely that the way you think about money, wealth and rich people is due to the programming of generations that have gone on before you. This would have come to you in a combination of three ways. Verbal programming, things you heard as a child. Modelling, things you saw your parents do as a child and then copied. The apple doesn't fall far from the tree. And if you say, no, I'm not like my parents, I'm not becoming more like my parents as I get older, have a look at your life partner, your spouse, and let me ask you a question. Are they becoming more like their parents as they get older? So you learned things in a combination of three ways: verbal programming, modelling, and also specific incidents, things you experienced, things you heard, saw and experienced. But are these beliefs, are these values, are these habits that you absorb passively over time still serving you well today? In fact, did they ever serve you well? And if you're like most Australians, the simple answer is no, they're not. They're not wealthy thoughts, and it's time you upgrade your programming, your wealth operating system. And the good news is the first step in the process of upgrading your subconscious programming is to become aware of the problem. That's the process I wanted to share with you today, to start at least by explaining what's happening to you at a subconscious level. It's very likely that you're living your life with one foot on the accelerator and one on the brake. You've got some empowering beliefs, but you've also got some disempowering beliefs. You've got some rich habits, and you've also got some poor habits. You've got beliefs about wealth and money and happiness that are helping you get in the right direction, and some that are holding you back. So the next step in reprogramming your wealth operating system is to remove some of the disempowering habits and replace them with empowering beliefs, empowering habits, empowering rituals. Now, that's not easy, and that's what I discuss in my international best-selling book, Rich Habits, Poor Habits. By the way, that book's been translated into 4 languages now. Chinese, 2 forms of Chinese, Korean, Polish, Vietnamese, and the Indian publishers are looking for it as well. Hey, by the way, you can go to richhabitspoorhabits.com and get a copy of it. But what I was trying to say is reprogramming your wealth operating system takes time, and reading a book will help you, but it's not enough. And that's why I put together my mentorship program, which over the last couple of decades has helped thousands of Australians upgrade their wealth operating system. It's an online program that I'd love you to be part of to help you take your life and investing to the next level. Now, you can read more about it. I'll leave a link to it in the show notes, but at michaelyardney.com.au. And when you join my mentorship program, you're going to learn the science of becoming wealthy. It's a program I put together for investors who want to know how to get to growing a multi-million-dollar property portfolio or a successful business from somebody who's already done it, and somebody who's educated more successful Australian property investors than anyone else. Hey, by the way, that's me. And remember the cause and effect equation I discussed a few moments ago. Your outside world won't change until you upgrade your wealth operating system and your inner world. And you can learn how to do this through my mentorship program. Just go to michaelyardney.com.au and get all the details. And I look forward to being part of your wealth creation journey. Well, thanks for spending the last little while with me, and I hope you got some benefit from this show. If you did, and you know somebody else who'd also benefit, please tell them about the Michael Yardney podcast. There's a share button on every podcast app. On Apple Podcasts, there's 3 little buttons down the bottom. Press it and share it, or just tell them about the Michael Yardney podcast. I hope you're going to be doing them a favour, and you'll definitely be doing me a favour and helping me in my quest to make as many people as possible financially literate. Now, there's ways of catching up with me between these shows. Just look for Michael Yardney on social media, or why not join my private Facebook group? Go to Facebook and look for the Property Update Facebook group. And I have a way of saying thank you to you for subscribing to this podcast. Go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where you can get a bunch of ebooks and reports. My way of saying thank you. And when you've got time, why not listen to some of the old podcasts? There's individual lessons in each of those that I think would be helpful for you. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?